Am I on? Okay, I think we're going to get started. People can grab their seats. So I'm Joel Levin. I'm the Vice President for Business Development with the Climate Action Reserve. And this session is going to be on the state of the market today, so the current state of the carbon market in California. The market has now been operating for about a year, just a little bit more, 14, 15 months. And when Mary Nichols talks about the market, I've heard her speak about it a few times, what I've always heard her say, among other things, is she wants the market to be dull. Her goal is that it's not interesting, it doesn't create headlines, and when I look back on how things have gone over the last year, I see things like we are now, in the next few weeks, going to be doing the 7th auction, and the 6th one was completed recently, and it did not make headlines. I don't think it was on the front page of any newspaper. The Air Resources Board has now been issuing offsets every 2 weeks on a pretty regular basis. They issued some yesterday, in fact, and it was not news. It was kind of a regular event. They've issued about 6.5 million tons now. Also, prices have been pretty narrowly banded for a while. They've been, fluctuating within a pretty narrow range. So when I look out at all these things over the last year, what I see is that what Mary wanted basically seems to be what's happening. At least that's sort of the narrative that I see over the market. And I'll be curious to hear what other people think, the panelists and you guys, as we go forward. So we have a group of panelists who are all very active in the market and represent different aspects of the market to talk about where things are at and how things are going right now. So each of them is going to talk for a few minutes, and then we're going to move into a conversation, and hopefully all of you have some good questions for us, and I'll throw out a few questions as well. Let me just introduce folks. So the first speaker will be Emilie Mazzacurati. She's the founder and managing director of 427, which is a boutique consulting firm that offers strategic advice on carbon markets and climate change risk management. And Emilie is kind of a long-time observer of the California market. She's seen it through a lot of ebbs and flows over a long period of time, so hopefully she'll have some good wisdom for us. She's going to give kind of an overview of things. JP Brisson is a partner at Latham Watkins. He's the vice chair of the firm's Air Quality and Climate Change Group. He really has a wealth of experience on carbon markets. He's been involved with them since his work with the World Bank, coming back from 1998, I think. And he currently represents some of the largest emitters and participants in the California market, so he can speak from that perspective. Roger Williams is the president of BlueSource. And BlueSource is one of the largest project developers for forestry projects in the California market. And lastly is Wayne Sharpe. Wayne is the president and CEO of Carbon Trade Exchange. They're a leading exchange for offset credits globally in a variety of different markets around the world. So we'll start out with Emilie.
All right, thank you, Joel, and good morning, everybody. Thank you for having me. So I figured I would start by throwing a lot of numbers at you, and then we can have a discussion on what those mean. Can you put on the first slide? Yes, slide. Beautiful. So let's talk a little bit first about primary and secondary market in terms of volume. So what happened in this first year of the market? Looking at the primary market, as Joel mentioned, we're on our 6th auction. There was one in 2012, 4 in 2013. We started the 2014 round in February. And so there's a lot of the market activity that actually is concentrated at the auction itself. We're talking about 48 million total for the state, almost 49 million of allowances auctioned by the state of California for the benefit of the state of California. So those are numbers for 2013, 10 million current vintage, so vintage 2013, and since this was last year, and 38 million allowances for future vintages were auctioned last year. There was also a large volume that was auctioned on behalf of utilities, mostly investor-owned utilities, just because they have to, it's in the law. Also a little bit consigned voluntarily by publicly owned utilities for a total, again, of about 48 million tons. So all in all, the volume for the primary market in 2013 was 96 million tons. And that raised a total of over $1 billion, of which about half went into state coffers, and the other half is going back to ratepayers through utilities. In terms of secondary market, we've seen just about the same volume on the secondary market, just a little under 100 million tons for 2013, and that includes all the options and mostly future contracts. That's the numbers for the trades on ice. It does not include, there's some amount of trading that is not cleared on ice on the Intercontinental Exchange. But roughly 100 million tons give you a good sense of how much volume there was last year. That comes out as about 390,000 tons a day, which is a small fraction of what sells at an auction, right? But it's every day. So what does this volume, what does this tell us about the market? Is this big, is this not? So there's two useful metrics that I just want to bring up. The first one is the daily volume. If you look at the daily volume on the secondary market as compared to the cap, generally you see that there's about 0.25% of the cap that's traded on a daily basis. And if you compare that to the EU ETS, the European market, there's about 1% that's traded on a day-to-day basis. So it's a much smaller portion of the overall allowance budget that turns over every day. This is still a market that doesn't see a lot of turnover. Looking at the other metric that I find useful is looking at the size of the primary market compared to the secondary market. And they're almost the same size, which is highly unusual for a carbon market. And then again, comparing to the EU ETS, auctions were almost non-existent for most of the time. It was always a market that was really focused on secondary market, on trading. And the California market is really set up in a different way, and it's probably going to stay that way with a heavy influence of auctions over time, because just because of the sheer amount of allowances that are auctioned rather than handed out for free. So now let's talk a little bit about prices, and if you can go on to the next slide. There's two main trends that are sort of the key takeaways from last year. Can you put up the next slide, please, with prices? Thank you. Prices, they're low and they're flat. And as Joel mentioned, ARB is running around telling us that boring is the new black for financial markets. Not everybody may agree with that, but it certainly is the reality right now in California, where we've seen a slow decline of prices towards the price floor, which is represented here with a dotted flat line at the bottom. And a convergence between secondary market prices, auction clearing prices, the little dots, and the floor price. Now, of course, the key question is, are those prices ever going to get lower than the floor price? And maybe that's something we can take up as a panel. The prices are also flat, and that's possibly a concern in the sense that they're not responsive to changes in fundamentals, in weather, in fuel prices, in the composition of the stack, in emissions from the transportation sector. They're just not responsive because the one overriding price driver is the fact that the market is currently overallocated. So this may change. What this means is that we're not seeing a lot of financial activity, of speculative activity in the market, which again is touted as a success by the regulators who created the market. It is possible that if prices became more volatile, if the market was shorter later in time, one would want those financial institutions to enter and provide liquidity for the market. So that brings me, and that's my last point, to market participants. Who are the participants in the market? So you have to remember that this is a really small market with somewhere between 40 and 50 what I call large emitters, so over 500,000 tons of emissions per year. And we all know them by name, and they're all here. A lot of the other participants have much smaller emissions and much smaller compliance obligations, either because they're large companies with a few facilities in California, or because they're small companies and they have a tiny compliance obligation. And so we've seen a lot of those medium-sized emitters enter the market, especially through auctions. There's been between 70 and 90 participants in every auction. A lot of municipalities have used the auction to fulfill their compliance obligations. It is quite possible that a much larger number of very small participants have not yet entered the market, but they will have to somehow before the end of the year when their first partial compliance obligation is due in November. So that's going to be another trend to watch, and this is my concluding thoughts here. What are the things to watch for, to look for in the next couple of months in terms of price drivers? First, I would look at the next auction and what happens, whether it's going to be fully subscribed or not. That's really something to look out for. What are the small emitters doing, and does the partial true-up in November generate more activity in the market? And the third thing to look for is oil companies. When and how are oil companies entering the market and start hedging their 2015 and later compliance obligation? And that really is going to make a difference in terms of market size, volume, liquidity. So I'll leave it at that, and then we can discuss the health of the market.
Okay, great. Thank you. JP?
Yeah, sure. Well, thank you very much, Joel and Emilie. Welcome, everyone. It's great to be here again. Joel, thank you for the Climate Action Reserve to set this up. Is it, what, fifth year now? Or 11? Obviously, I'm dating myself. Yeah. The only one I remember as far back is the one in San Diego, which was quite a lot of fun. That was in 07, maybe. But anyway, well, in thinking about, key market developments over the last 12 months since we were last year, from my perspective, I guess three things come to mind, which I did not necessarily expect. If you had asked me the question last year, I would not have necessarily given you those key developments as being, what to look for in 2014. But the first one is the enforcement level that we have seen of the program. So, in thinking, and from a legal perspective, in thinking of a new set of regulation, which is as complex as the cap-and-trade regulation and the reporting regulation, normally, people with experience working with these regulations in California and other states and at the federal level would have expected a certain transition period whereby compliance entities, covered entities, market participants would have learned about the rules. The agency would have issued some guidance, and there would have been a dialogue, as a result of which maybe after a couple of years of implementation, you would have seen some enforcement starting. But the reality is that a year and a couple of months into the program, ARB has now announced more than 16 settlement agreements with market participants over violations of the program. And the level of enforcement of this program is actually quite surprising to a lot of market participants, including myself. So these settlement agreements are public. They are on ARB's website, and you can look at them. But there's been more than 16 announced, and they range between $10,000 and $350,000 per settlement agreement. So those numbers are actually quite high, in my experience. And the things to keep in mind or to note are that in addition to this being a new program and the level of enforcement being quite aggressive, when you look at the nature of the violation that are alleged in these enforcement action, most of them relate to the reporting regulation. And when you think about it, these regulations started in 2008, really, to have a binding effect on compliance entities. So what you realize is that ARB is starting in 2014, essentially, to enforce against activities that took place in 08, 09, 10, and 11. So what I think this means is that what we are seeing right now in terms of enforcement could actually be the tip of the iceberg. And as the agency goes through various reporting requirements, but also various requirements under the cap-and-trade regulation, we may actually see in 2014 and 2015 increased enforcement activity. The second point I want to make is that so far, most of the regulatory scrutiny has focused on the reporting requirements. And the reporting requirements are actually, the requirements are not very clear always, but the reporting is a black or white issue. Yeah? So it is actually fairly easy for the agency to come out and enforce those requirements. But as the market further develops and as the agency starts looking at more difficult concepts such as prohibition on beneficial holding, transaction structure, disclosure of information, resource shuffling, I think the activities around enforcement of the market and market monitoring issues will become increasingly complex. And I think as 2014 progresses, it's going to be an issue to keep an eye on. The second market development I think is worth noting here is the linkage with Quebec. So, Joel, you said that Mary likes to say that she enjoys, having a dual market. And actually, I have to say that a lot of us in the market thought that the linkage with Quebec would be like a big splash. Something would happen, we would see that in the market. And I would say that most people don't realize that the linkage actually took place on January 1, 2014. And as most market participants know, ARB and the Quebec government do not track the serial numbers, or I would say, do not make the serial numbers of the allowances visible to the account holders. What this means in practice is that since January 1, 2014, any transaction that has been made in the KIT system could involve either California allowances or Quebec allowances. So right now, parties are doing transaction in the market and potentially receiving Quebec allowances as a delivery. And this is not something that is necessarily being noted by the market. So, for example, ICE has modified its futures contract terms to allow for the delivery of Quebec allowances to satisfy the futures contract. So this is one adjustment that we've seen in the market. But what it means is essentially every compliance entities that has an account on KITs could have Quebec allowances in their account today. And that is something that has happened with a very smooth transition. We haven't seen any price spikes, which is actually quite surprising relative to what people were expecting. The last point I'd like to make is just to follow on what Emilie was explaining earlier regarding the market participants. Anecdotally, what I can say is that over the last couple of months, I have seen an increased level of participation from market makers. And in my view, this is a sign of a healthy market. There are a number of entities in the California market that may not have the resources to actually go into the auction, participate, and do everything they need to do to actually procure in the primary market for allowances. And market makers can play a very important role in bridging the gap between these entities and the market. So the fact that you have certain market makers in the market today offering products to smaller covered entities, to me, is a very good sign. And you have seen, as a consequence of that, some hedging products being developed in the market that allows compliance entities to hedge out the risk of the market over several years. And that is, again, a sign that the market is relatively stable, is attracting some interest from the market makers, and will eventually help compliance entities achieve their obligations under the program. So that was the last point I want to make.
All right, thank you. So, Roger, talk to us about offsets.
Thanks, Joel. It's really a pleasure being here, and I'm excited about this panel because I think it's quite complementary in that the focus of Emilie, JP, and Wade, and then for myself, my company, we are the oldest and largest offset developer in the United States, and so we've been selling credits into the carbon market domestically and in Canada for over 12 years, and there's a real focus for my company now on supplying high-quality projects into the program in California. And just as a lead-in, for us, there's just a high level of excitement right now. For having been in this business a long time, seen a lot of highs and lows, seen a lot of expectation around a federal program that hasn't happened yet, right now, the level of interest from buyers in the market and also a level of interest from suppliers of projects is truly unprecedented right now. And so that is a function of the design of this program and the fact that, I think this has come up a few times, that the fact that there are no scandalous headlines as of late or at all related to this program yet. Is that boring? Well, in this context, I think boring is really exciting. And it's leading to some stability. And for people to now enter this market and say, look, I do want to participate. And so for my comments here, I am going to focus on the offset piece. If you can go to the next slide, please. First off, in terms of pricing and demand, just dotting the I on this point a little bit, looking at the allowance auctions that have taken place so far, one of the primary points is that in every instance, the auction has cleared above the floor price. And I view this as a little bit of a Goldilocks situation where you don't want the prices so low that they're hovering at the floor, and yet you don't want them so high that people get nervous about price spikes. And so what we're seeing so far is that, you know, it's healthy margin above. We'd love to see it a bit higher, but I think this is an indication of, again, good design of this program so far. Good start out of the gate. I think Emilie mentioned the $1 billion mark that was passed last year from auction dollars that have come in. I think that's very powerful and in many respects in terms of the buy-in and I think potentially the longevity for this program. Under that next bullet around looking at some of the out years and some of the allowances that have been sold out both in the third quarter and the fourth quarter auctions for vintage 16 allowances, and then in the most recent auction, the vintage 17 allowances that were available for purchase were all purchased. And so I think that's also a nice indicator that people aren't looking at, well, what's just going to happen this year or next year, but you know what, I'm going to buy several years ahead. And I think that speaks to the confidence around that this program will be around for a while, and we certainly hope well beyond 2020. Offsets trade at a discount to allowances in a range of 15 to 35%. Based on what we've seen so far on clearing prices, the average clearing price is around $12.15. If you apply then a 25% discount for what offsets would generally be selling for in the market, that ends up being $9.11. Again, these are rough numbers, but that's a good number. We can get a lot of projects done at that price. There's a lot of landowners in the case of forestry that are willing to participate in this program, I think, based on that type of pricing. In terms of demand that we're seeing right now, we are in a situation where there's a number of buyers that have done first contracts with us that are coming back now and saying, okay, that went well. I'm definitely still in the market. What else do you have? And I think part of that might be due to the transportation fuels coming under the cap next year. And so I'm speaking from what we're seeing in the calls and the conversations that we're having, again, around this level of interest where it's not a first step into this market, but a lot of buyers now where we've already done 1 or 2 or 3 deals and saying, you know what, we are still in this market and we're looking for more, and so that's exciting for us. I think let's go to the next slide, please. So this is as of yesterday when ARB released 8 new projects that were included in this overall list. And this slide shows the offset credits that have been issued to date. You can see that it's 6.4 million tons total, 40 projects. A lot of those are ODS projects. I am proud to say that our first RBOCs, our compliance commodity credits, were issued yesterday, and so that's showing up under the U.S. Forest line item there, and it's something we've worked long and hard to accomplish, but happened yesterday. So again, some momentum in this market. Currently, 64% of this volume is from ODS projects, and 34% for forestry, and a small portion from livestock. And then there's a whole slew of additional, what we call early action projects that are listed, but I should note that plenty of those, it's possible that not all of those will make it finally into the market and be given compliance credits. And so one thing around this component, when we look at the supply and what's coming into this market, there is a backlog right now, and I would primarily point to the early action component. These are projects that we and other developers worked on years ago and had registered on Climate Action Reserve and now working also with ACR. And what we're seeing is that there is this backlog at ARB, and we're in touch with the folks that are implementing the program at Air Resources Board quite regularly, and I think they're doing fantastic work, but I think ideally there would be a few more people that can help on this backlog. To put it in a little bit of context, in a recent conversation, I asked about a project that was sitting on their desk that was now the 10th in line for forestry projects that are kind of in the queue, and estimating around 2 weeks per project in order for their review. That's going to be 5 months after we've already been working for literally years on these projects. And that's something that's problematic when you're talking about the supply curves and what will be available in this market, that you don't have things that just get stuck there. And again, this is purely a function, I think, of the ability to spend enough time and resources on these early deals that now should come into the market. And on a similar note, I will say that I would hope and encourage the Air Resources Board to rely a little bit more heavily on the registries and the verifiers that are accredited under the program. There's a lot of thorough review that take place on all these projects before they get to ARB. And what we're seeing is that in some instances, it feels like they're starting anew on a process that already has gone through quite a level of rigor, 2 or 3 or 4 steps that have already taken place of a complete review of projects. And so that would be one recommendation on just seeing this volume, seeing this efficiency of volume coming to market to speed up a little bit. Next slide, please. So this is a Thomson Reuters slide. I have 2 slides quickly just on what the supply picture looks like. This is an annual view of supply coming into the program from various different project types. I will note that in this graph you're seeing a couple of project types that currently haven't been approved. One is coal mine methane. It's been renamed mine methane capture. That's scheduled to be approved at the end of this month. We're excited about that. We think there's going to be a lot of great projects that will come from that. N2O and red, those have not been approved yet, and I think there's a real question mark on at what point those will be approved and whether they will come into the program. So on this slide, they're counted as contributing to the overall supply. But I think that's an instance of we'll see, and there's a lot more comments I could make around some of the challenges, but I think there's a path towards those, but I don't see those entering in the near term. My view on this is that for the project types that have been approved, that there should be more of a focus on just streamlining that process for these protocols that have been vetted, that now projects have been developed under. You see the first credits being registered, and for that process to get streamlined overall. If you go to the next slide, please. This is one more snapshot, and this is a cumulative viewpoint looking at the 4 current project types that have been approved, and then including the mine methane capture and the RICE protocol, which is scheduled to be approved also in the near term. And again, it shows a shortfall in overall supply of offsets into the program. To put a little bit of a finer point on that, the aggregate numbers from this analysis shows a total of 131 million tons of offsets coming into the program by 2020. Notably, while we've seen a heavy volume of ODS projects so far, that is expected to flip-flop towards, or flip towards forestry projects. So by 2020, it's anticipated that 67 million tons will come from forestry projects, 32 million from ODS, and 25 million from mine methane capture. And so, this overall, and I think to wrap up in my comments, we feel like things are moving well right now. The demand is there. The pricing is strong. The suppliers that we're dealing with are coming in, and word is getting around that, look, this is different than what we had seen historically in the United States for carbon. Compliance market, legislative mandate, a program that's been years in the making, the first projects that have made it through at a strong price. You know what? I think I might participate in this. And in the context of our forest carbon work, we are working currently with pension funds, timber investment management organizations, large conservation organizations like Nature Conservancy, Audubon Society, private landowners, hunt clubs. These are all folks that are now under contract with us that are looking to do more projects based on what they're seeing in this market so far. So we think all of that is in the context of being quite exciting. And then last slide, please. So again, we are working hard to bring projects to market, and this is a bit of an odd slide, but to end on this note, what you're seeing here is actually doing a verification in the field a couple of months ago where for forestry projects, you need to locate a plot center, which is a piece of rebar that was buried under 4 feet of snow. And we needed actually high-powered metal detectors that then, it was so cold that we needed to make a fire to heat up the batteries that were malfunctioning because of the cold. And so I think this is a metaphor for so many participants in this market, not just ourselves, but all the developers, all the registries, and ARB, absolutely, that you need some tenacity to make this stuff work. And we definitely feel that, but we're seeing some results. And so I'm ending on a note of excitement here, and a lot of thanks to a lot of people who are working as hard as they are to make this market work. Thank you.
Thanks, Roger. That's a great note. I'm thinking, wow, I'd like to be out there snowshoeing right now. But Wayne, you want to tell us about the role of exchanges in the market?
Well, as many of you may know, we started a carbon trade exchange in London. And we were there during the peaks and troughs of the European markets, starting initially in the voluntary market with and we built our first technology solution to connect to the European compliance market through CDC Climate, which is owned by ultimately by the French government, and the French National Registry. I think there are a lot of market participants in Europe that would have been very happy with boring. So a lot of the problems that happened there, of course, have led to some of the design functions that have been so superior here in the market construction in California. By going and having a look at the problems that other, as I've always said in business, learning from someone else's mistakes is much less expensive than making them yourself. So the part of what I'm going to talk about is to look at how we can see the future of the market evolving into and what the drivers can be going forward, because that's the time for me to arrive when we obviously the market globally in a large sense has been driven by the suppliers building first because the regulators take so long to get their act together to come up with the cohesive decisions on how to drive the regulatory process. And so once you get the first stage of the market where you've got that regulation in place, it's initially the main driver, of course, is that regulation. And that's why if it's well designed as this one is, then you're going to get boring pretty quick. But the next phase of those drivers comes from other participants. You talked about the market makers, the financial institutions and banks and speculative trading, which is driven by exchange trading. And that's why we're looking to come into the market now. So we needed to see that it was sufficiently stable, and we understood that everything, the structure was going to work properly. Otherwise, we would have had the same problem we had when we moved to our headquarters to Australia, and then find some muppet decided to change the rules, and next thing we didn't have the market we thought we were going to have. Our exchange, of course, runs on two different platforms. One is the regulatory platform, and the other one's the voluntary platform. As you would all be aware, or if you're not, I'm telling you now that we have the ability to trade all of the Climate Action Reserve and American Carbon Registry credits, including the
We back on? All right. So obviously, Wayne's conversation about exchanges was setting off some alarms someplace. So we're going to pass it back to him, and please continue exactly where you were. I don't know if you recall what you were talking about.
I think that the drivers, as I was saying, become slightly different as the market starts to mature, and a well-designed market matures obviously more quickly. Part of that maturity, of course, comes with introducing new technology solutions, including the exchange platforms. Even looking at some of the issues such as the price differential between your offsets and allowances, I mean, those things start to become arbitrage opportunities when you've got exchange platforms to trade off. Regulatory and reporting and compliance is a little easier to do if you've got a transaction log that shows electronically everything that's happened and it's connected to the registry. So in the voluntary market, which is where our first exchange platform was built, of course, the reason why we've got arrangements with Climate Action Reserve and the other ones who won't be named because they set off alarms, apparently. No, I'm not risking it. We can trade. We've got different drop downs for not only the different credit standards, but also for the different types of credits within those standards. So an early action CRT is listed as separate from a normal CRT. Right? So we can basically facilitate the multi-stage trading of those and through different hands. So in other words, someone could, there's all sorts of business opportunities emerging once you start looking at that, where you can, someone can have a business where they'll take those early action credits and take them through the process rather than having to be the responsibility of the project originator. Right? So there's a business opportunity to wedge in there and do the work to drive that forward by using the exchange platform to purchase and then resell. So one of the good things about having the electronic functionality directly into the registry is it enables you that it's a simultaneous transaction for the money and the credits, and then you can retrade those credits. You don't have to buy just to retire. And that's where the spot market exchange changes the dynamics as well. So if we can have a look at the first, I'm going to talk a little bit about what's happened in Europe so we can start to see some of the opportunities that are going to start to emerge in this market, and probably much more quickly. So the first of these shows how the OTC market, which is how all these markets start, and as the introduction of exchanges came on board, spot exchanges specifically, the dynamics of the market changed. And you can see quite a dramatic difference as the market started to mature, shifting from OTC to exchange traded. And many of those OTC contracts were actually exchange cleared. So what happens then is we've built an exchange clearance portal for OTC transactions. So you're then working on a standard exchange agreement, and you're doing the clearance and settlement is all being done by the exchange, even though it was an OTC contract. That's a name give up to the exchange. But the other thing is that in a futures contract, and we focus on spot trading, and the reason for that is because I came into this from an environmental perspective. So in a futures contract, you're just trading a contractual arrangement, whereas a spot transaction means that the funds are ultimately flowing to a project who's actually doing something about climate change, and that's why I've always focused on the spot market. If we go to the next slide, now this, obviously there are all sorts of issues in the European market which caused some pretty serious disruptions, as most of you may or may not know. There was a massive price collapse because of allocation issues in the early days. And there was also some very significant issues around both pricing and volumes in relation to the fraud that took place, particularly the VAT fraud, and then subsequently the theft of credits. That theft of credits, of course, led to the closure of the spot market for the interfaces, and all the spot markets disappeared, and they've now all ceased to function. We are now about to go back into the European market because that reconnection capability into the central European registry is going to take place. So, but you can see there that what the exchanges, the introduction of the exchanges, what it did was two things. First of all, it drove a different style of market, and secondly, what it did was drove the whole market. It lifted everything. The amount of OTC trading, of course, fluctuated with some of the issues that were revolving around the exchanges. I mean, for those of you who don't know, for example, Bluenex was fined a very substantial amount of money by the French government for their assisting the VAT fraud by not doing proper know your client and anti-money laundering and proper credit checks on people. All sorts of stuff like that. We've complied with the German government's anti-money laundering requirements from day one, even in the voluntary market. So if you go out to set it hard and right at the beginning, makes it a little more difficult, makes it slightly more expensive to bring members on, but of course it means that you've got a secure structure and you know exactly who you're dealing with. That's why we're dealing only with the top banks in the world for our financial clearance. Our first clearance and settlement account was with Deutsche Bank, now with Westpac in Australia, and here we'll be with Wells Fargo here in the US. So the pricing issue, of course, many of you may know, that was also largely driven by issues revolving around CERs, which was an oversupply issue in the market. And a large part of that was then subsequently driven by the types of credits that were allowed to come in as offsets. If anything, I think your point showed that they need to expand those protocols pretty rapidly to allow more credits to be produced, so there's more offsets available. That makes it a more financially viable proposition for everybody in the market. But what happened during the peaks of this market? There's one more slide, is there not? Yeah. So here we can see this is in the first few years. So I just wanted to show you the early phases of the market. Forgetting the fact that the price went through that massive yo-yo because of the issues that they had in the phase one, the volume of the market just started to exponentially accelerate as the exchanges come on board, because that allowed the financial institutions to enter the market. That allowed banks to set up major trading desks and people who weren't necessarily direct participants to start to provide that service. The fact of the matter is that even though most of the emitters were trading through brokers at that point, and many of them through big broking houses, there were over 500 trading desks at the peak of that market in Europe. And certainly there wasn't 500 brokers. So there were lots of financial institutions, and some of the emitters then, on the back of the spot exchange market, were then able to set up their own trading desks, so they could trade, buy and sell credits on a regular basis, not just buy, store and retire, and which is sort of the shape of the market at the moment. So it's that churn, that secondary market churn, that starts to expand all the other parts of the sector. Now, we expect that will all start to come back in Europe now that when we come back in with the spot market. You know, what's happened, of course, at the same time as the spot market stopped, the futures contracts suddenly got shorter. So all of a sudden they weren't a future anymore. It was a daily futures contract, which is still not a spot market exchange. So we're seeking to have exactly the same technology interface here with the ARB, where we'll be directly transacting in and out of the registry for spot market transactions, and that'll then provide the solution when people have to satisfy demand for a futures contract if they're not the actual participant. So it makes it a little bit easier then for a financial institution to trade, or any speculator even, to trade in the futures market if there's a spot exchange sitting to the side who can deliver when they need to deliver, if they're not sort of someone who's a general market participant. So that's why we're coming to America. Set off the alarms.
Good, thank you. One question I have, I think this is, I'm going to start by throwing out a few questions to folks, and hopefully you all have some questions as well, and so we can turn this into a bit of a dialogue. So you might start sort of teeing up your questions, and in a few minutes I'll pass it over to you all to ask. But one thing I wanted to ask to start out is, to what extent do each of you think that this is a healthy market? This is something people kind of touched on. Is it a robust, is it a healthy market? Are there things that could be done to make it stronger looking forward? And this is something people kind of touched on, but I wanted to circle back to it. So whoever has comments.
Sure, I'll jump in. You know, I think it's pretty good considering, is this on? Yeah, it's pretty good considering where we started, where all the concerns that there were in terms of would the program go through, the legal challenges, the ongoing regulatory process to change the rules, the small size, the small number of participants. All in all, it's not bad. There's market, there's transactions, there could be more volume, and certainly more liquidity. I think is the biggest thing. Certainly, we don't have to complain about volatility right now, but more liquidity would bring just more depth to the market and more robustness to potential events.
It's a healthy baby.
It's a healthy baby, certainly.
I have two comments on that. I think as a general matter, this is a healthy market. I think ARB and industry have spent a great deal of time trying to design a market that is as efficient as possible given the liquidity constraints and the notional volumes constraint. I think where structurally there are still some work to be done and unfinished business are first the holding limits. I say that every year, and I think the big emitters have said that every year. I think the holding limits as currently designed, could potentially negatively affect liquidity and could potentially result in certain entity exercising some market power that they should not be able to exercise. So I think a study is currently being prepared by some of the members of EMAC, and I look forward to seeing the results of that study when it comes out. But I think a holding limit is something to keep an eye on. Second, I think is unfinished business is this concept of a price ceiling. And I know that when prices are at $12, the last thing people want to hear about is a price ceiling. But let's remember that we have a market which is still very tight. The prices could escalate very quickly. And, Wayne said it's a market that is structurally an improvement over what we had in the EU. And I think you referred to the price floor in the auction. But let's remember, we have a market with a price floor, but without a real price ceiling. And I think ultimately this is a deficiency in the market. And just saying that we are going to explore this issue in the future if prices increase, I think is not an adequate response. I think eventually we need to look at this issue and consider having price ceilings in this market that are hard caps on the price of allowances.
Mm-hmm. Yeah, I think the comment about healthy baby might sum it up pretty well. But I'll reiterate that boring is exciting right now to us. And from, again, the perspective of an offset developer, I put it more in the category of ironing out what could still be considered maybe some growing pains in various points along the way. I know I mentioned the early action backlog at ARB for projects that are developed directly under the ARB protocol. There is a regulatory timeline of 2 months for review. So I don't want people to get the misconception that, wow, projects are just going to be stuck forever. I think this is a point in the program that you're seeing of basically getting these early deals into market. But one other side of that are the third-party auditors, the verifiers, that we need more of them. And hopefully they're seeing enough of an indication around the deal flow, the projects that are coming, that they're hiring to meet that. I mean, we have a phrase in my company now that verifier in Africa, like you're in the middle of a project and all of a sudden the lead guy is gone with no cell reception for 2 or 3 weeks. And it's kind of a joke, but it's also real. And when you're in the midst of development and laying out expenses that you need to recoup and get a project to market for a buyer that has contracted for a delivery date, it's very problematic to have a verifier in Africa. And so I'm making light of it, but it is a real problem that I'll chalk up right now to growing pains, but we certainly hope that some of this stability and what people are seeing in the market kind of has this ripple effect where verifiers staff up, leads to more efficiency, and overall this development cycle timeline is shortened so that we can bring good supply to this market, again, from an offsets perspective.
Well, we've one of the things which we'll be sending out, hopefully the announcement today, but I'll be able to tell all you lot because you're here, is that in order to help flow this through, many of you may have heard that we developed a non-activated VCU solution for VCS, where basically credits that had done every part of the process, including the verification, but hadn't paid the issuance fee, is the only step left to do, we can deduct that electronically at the point of the first sale transaction. We've now able to announce that we've got an agreement to do exactly that for Climate Action Reserve credits as well. So the development process will take a little time. We don't have an exact timeline on that yet, but that's an exciting innovation, because what that means is it's another hurdle of getting projects up and running, and enables you to take the issuance fees out of the proceeds of the sale, along with our transaction fees as well. And of course we include in that all the credit transfer fees. So everything is all wrapped up in one transaction, all done electronically. So that's the sort of technical innovations that allow you to start pushing a market to grow. Of course that's in the voluntary part, but of course those voluntary credits, I said, can migrate via exchange all the way through. And then of course once we can get the linkage with the ARB, we'll be doing them after they turn into a Californian offset, and doing the allowances, spot allowances as well. So we're pretty excited about that anyway.
So it seems like there seems to be a bit of a consensus among us that the narrative over the last 12 months is we have a boring but healthy baby. Babies are boring ever. Do any of you have any thoughts on what the narrative is going to be over the next year? You know, if we were to come back and do this session a year from now, what would be the story looking back over 2014? Is there any kind of theme that you think is likely to be the story going forward over the next 10 months?
Well, what you said, if you look at the method that they've gone through in the Australian market, even though it's gone through a couple of pretty tragic, big transitions, the interaction with the market from the regulator has been one of the things that's changed dramatically, because they realised that they weren't getting the feedback that they needed. They were getting it, So I think that's one thing. I've noticed the ARB is actually pretty good at that. So if I look at some of the European things, it takes forever to get anything changed there, whereas here they seem a lot more responsive. So I think that maintaining and developing that dialogue with the ARB in terms of how to make the market more efficient is something that that needs to happen more often. I think that part'll help get those whatever those bits that are gumming up the works sort of thing. A lot of that's just systems and management and understanding what the problem is and then working out how to fix it in collaboration. I'm not trying to tell them how to do their job, just trying to make sure that they're supporting the market as well as monitoring and disciplining it when it's bad.
I think, I think if prices stay stable and increase, don't crash, a lot of good things are going to happen in terms of the efficiency in this program. That's kind of what we need, the lubricant for this market, right, is that price on carbon, and for that to be stable, predictable, and when people are making long-term investments, when people are committing their acres for 100 years, that's what they need to see. And so I think so far it seems like we're on the right track, and so being glass half full guy, I think I'm optimistic about that, and so I fully expect that is what's going to take place. I think it is going to be interesting to see how the transportation fuels coming under the cap, how that's going to play out in terms of demand. I think we're seeing some of that now, as I already mentioned, and so maybe we're looking at that boring, healthy toddler and avoid the terrible twos or something.
You sound like you speak from experience.
Yeah, right in there.
Yeah, actually building on that, I think when we look back, we'll look at that first compliance period in those first 2 years as a continuous period in terms of slow growth and stability. Based on what we know today, there's no reason to expect any major drama in the coming year. The real changes are really going to come in 2015. But I would expect 2014 to be very much more of the same, fairly regular prices, some growth, continuous growth at a slow rate, and more market participants, a little more liquidity over time. I think the real changes are really going to come when the oil companies enter the market. Developments on the federal level in 2015 may really start changing the game, and I know you have other panels talking about that, but it could really become a game changer in terms of what happens in other states, and are we seeing developments on the Pacific coast or with Mexico that can expand the market. And maybe some of those 2015 changes will start spilling over, and we'll see some of that towards the end of the year. But the bulk of the year is really going to be more of growing and setting roots and establishing, becoming settled as a market.
What about other linkages? Is there anything fleshed out about more linkages other than Quebec?
Well, the only thing I was about to say, but I didn't say, was, I mean, the biggest difference in, well, the next development in terms of linkage is the joint auction. Yeah. So right now you can have an entity in California that buys or sells allowances with a counterparty located in Quebec, and the transfer can take place on the joint registry. So that's fully operational. It's been done, it's been tested, and it's working well. What's not being done is a joint auction, as a result of which right now you have an auction clearing price in Quebec and you have an auction clearing price in California, and they're different. Yeah. So that's interesting because you have two different prices on the same fungible commodity.
Different screens, so they'll be able to trade that.
Well, okay. Well, maybe that too. But so I think that's going to be a development for 2014. Yeah.
So I'd like to throw it open for questions from you all. There's a microphone here. If people want to ask some questions, please identify yourself and toss out some.
Everyone knows this.
Yeah, I know. Brad, you don't need to identify yourself. But, yeah.
Hi, I'm Brad Neff with PG&E. I wanted to go a little further where Wayne started us going on linkage. I know there are a lot of panels that will talk about linkage, and we talk about this market growing up in terms of more offsets, more industries. There's some tweaks around the edges that we're hoping to see in the program itself. And other panels will talk about policy alignment. But as we trip over that line to actual linkage and joint auctions and that full linkage, what is the impact on the market? And perhaps you can talk about the benefits to liquidity or other things that we will see as a larger market because of full linkage.
Well, it's very interesting, Brad. It's a very good question. So if you look at the data that came out of WCI a couple of years ago, that data showed the Quebec market as being tighter than the California market in terms of emissions relative to the cap. And the reason for that is that the Quebec economy, in terms of efficiency, in terms of greenhouse gas emission, is actually quite high because it's mostly based on hydroelectricity. So trying to reduce greenhouse gases in the Quebec economy is actually quite challenging, and most of the reductions need to come from the transportation sector. So it makes it a tough market a tough economy to reduce the greenhouse gases emissions from. So the preliminary analysis from WCI showed that as a result of the linking between Quebec and California, the prices in California would go up, depending on the base case, by a couple of bucks, $1, $5, or $9, I believe, were the case scenarios. Now, what's interesting is that the first few auctions, or two auctions in Quebec, have actually been undersubscribed and have cleared at the floor price. So even though the studies and the economic outlooks were telling us that the Quebec market would clear at a higher price, in practice what we're seeing is that, because I think of reason that people are still trying to work out, and I'd love to have Emilie's views on that because I know you do some work in Quebec, the auction are not being subscribed as much as people were expecting, and because of that, we have a floor price. And when you factor the exchange rate between the Canadian currency and the US currency, the delta between a Quebec allowance sold in a Quebec auction and a California allowance sold in a California auction is quite significant, even though from a pure regulatory basis, these two products are completely fungible. And as I said, they're not only fungible, you cannot even tell which one is which in kits. So anyway, I think these are interesting dynamics.
Well, on Quebec, I think Quebec compliance entities just haven't really entered the market yet. They look at this as something that's far ahead. Quebec does not have a partial true-up like California has, so there is nothing happening this year for compliance entities in Quebec. It's all going to happen in 2015. And I think there's a sense that the supply and demand balance in Quebec is somehow irrelevant to their compliance exposure, in the sense that they're just going to go and buy California allowances, right? And it's a huge supply as far as they're concerned, and the market's oversupplied. So that's the main driver in Quebec, is the oversupply in California. Now, to get back to the question of linkages, it's not black or white. There's a continuum in terms of linkages going from the sort of the more polite policy alignment version to the full-on, fully integrated linkage with Quebec. There can be a lot of other ways to bring in credits and volume and interest from other markets, and the EU has done that with, or they tried. If Australia's market survives, we'll see. You can allow partial usage of allowances or offsets from other programs up to a certain level. You can do different things. You could potentially envision a linkage with RGGI that would have some kind of conversion rate to make up for the fact that allowances are actually trading at half the price in RGGI. There's a lot of ways that the California market could go beyond its own borders that could bring just some excitement, good excitement to the market, without necessarily taking the depth of integration and of coordination that it has taken with Quebec.
So does linkage mean we have twins now?
Step siblings everywhere.
So we had an interesting set of experiences in the Australian market. You're allowed to buy offsets as CERs out of Europe, right? Now, you know, we were talking about at the moment, $23 fixed price in Australia, and you can probably buy a CER in Europe for 23 cents. Yet hardly anyone's doing it. So what it means is that this is where the technological solutions come in my view, right? I think this is where the dynamics change. I'm not just trying to plug ourselves up, but you know, when you can do a screen-based trade, you don't have to be an expert. You don't have to go and understand how to buy credits out of another market. You can just do it electronically, and all of a sudden it starts that flow of trading that is a little more difficult when you don't know anyone in Quebec and you haven't been there, and how do I do that, and how much is the lawyer going to charge me to do it? Those sort of things. But it's really one of those things where once you start to make it simpler, then it's just easy for them to do a transaction. Even with that massive price differential, very little of that trading is taking place, right? And so here we've got an arbitrage opportunity that's obvious, but it's not easy to do if you have to go, work out how to do it.
Some more questions from the floor? Yeah, come on up.
Another person who does not need an introduction.
Good morning, Ralph Moran with BP. Question for JP, but anyone feel free to jump in. As you know, the cap and trade reg continues to be tweaked, and industry continues discussions with CARB about particular aspects. The word of the day is boring. JP, do you have any thoughts on particular parts of the regulation that could keep the market from being boring because of a potential impact on either market participation or liquidity? Parts of the regulation that you think need to continue to be looked at?
Yeah, no, that's a good question, Ralph. Thank you. Well, I mentioned holding limit earlier and price ceilings. Another one that comes to mind, and I'm sure all of you have read the 447-page 15-day rulemaking that came out last Friday. Yeah, very interesting. You cannot even carry it in your bag anymore. It's so large. But there are some interesting movements on a couple of fronts in that 15-day rulemaking. First of all, just to give you a quick example, there's a requirement for market participants to disclose their advisors, which is very interesting because it basically, in some cases, would require market participant to disclose the fact that I am personally advising them as a legal advisor, which is, from a legal perspective, quite problematic. There are also some proposed new requirements in the regulation that would require every participant in the auction to make 100% disclosure of all their corporate affiliation worldwide, even though the affiliations involve entities that do not operate in the California market. So think of a multinational company that is, has activities in California, has emissions, need to go into the auction and buy some allowances to comply with California law, but also happens to have some operation in Singapore, yeah? So why would that entity need to disclose the Singapore affiliate if the Singapore affiliate is not involved in the California market? Is I think a good question to ask. But it would appear that ARB is trying to force the disclosure right now in this 15-day rule package, and I think that could be quite burdensome for for some market participants, and would potentially be an incentive not to participate in the auction. So actually, I view this as a requirement that could have potentially negative effect on auction participation, on auction clearing prices, and ultimately on liquidity.
Wouldn't they just then move towards the secondary market as long as that's got good liquidity in it?
I mean, presumably they would need to go OTC or the secondary market cleared exchange. Yeah.
A couple of thoughts on this for, okay, well, what could make things more exciting, maybe not in a good way? Design of the program, and I think there's kind of three areas that I think about that play off each other, and one is allowance allocation, right? And are we heading to a point where there was a design flaw? There's not enough scarcity in the market to create a price that's meaningful in order for, at least on the offset side, for people to participate. And I know we saw this in Europe, and so this is something that I think people are nervous about, but this is going to play out, and the other factors that are going to influence it are, in part, I think the complementary policies, the RPS and the low carbon fuel standard, where RPS seems like it's, will let's say, I think easily be met, thereby reducing the overall fossil fuel emissions in the state. Low carbon fuel standard has gotten off to a relatively slow start, and that could end up having the opposite effect, where the cap and trade program is going to play more of a role. Mm-hmm. And you could ask anybody, and I think you'll get different opinions on this, but these are the components that are part of the regulatory mechanism, and I applaud the state for having thought about these different components, but how these will all play out is going to be pretty interesting over the next couple of years. And I'm not overly nervous about it, but we're certainly keeping an eye on it.
Sure. What about the potential of the offset reversal thing? Does that affect you guys?
Sure. So the whole component of invalidation is something that's created a fair amount of headache to then go through a long process and have a credit issued, but yet it could be deemed invalid for either 8 years out or as short as 3 years. And so for contracting, it's definitely it's a little bit of a hot potato. Who holds that risk, right? And I think that's no surprise. And so there's various different ways people are managing that risk now. It's something that I think is in this market, and it certainly is creating some headaches. We wish it wasn't there. We don't think it's necessary, but it is a function of this program right now. And so
that would be one that would probably something worth addressing from a regulatory change.
Yeah, well, I think we've tried to do that for 5 years, and I don't think it's going anywhere. But I mean, I think there's been some development in the market on that. I mean, I remember a few years ago, people contractually wanted this to be a buyer's risk, 100%. To me, that was a very surprising approach. What I've seen more recently in the market are credible offset developers like Rogers' company, offering different options to buyers. Yeah, so these guys are very credible. They have a large portfolio that they can draw upon, and it is now possible to actually request from a seller some kind of protections around the invalidation risk. And I'm very happy to see that development, because I think unless you have sellers taking responsibility for their product, I think it makes it difficult to develop the secondary market and the liquidity that we need in the market to generate capital that goes back to you guys to develop those projects. Yeah.
Yeah. I mean, the part of it that's problematic for us is that it just increases costs on these projects in time. I mean, and the recommendation and what we would hope would have happened, or maybe could happen, but it seems doubtful, is again relying on these steps that take place, these accredited bodies that are paid to verify, have they done a good job, and don't hold out this period of, well, just in case they didn't, we might take this back, because that creates a lot of confusion in the market. And we're facing situations now where we'll verify a project, have a project verified, then it'll go through review by the registry, go through review from ARB, and once we go through those 3 levels of review, the next year we might need to go out and do the whole thing over again to truncate this invalidation risk to 3 years. Arguably, that's too much. Does it really need to go through that many steps of full review? Is part of what creates a little bit of angst for us, but it's in the market now, and so I'll leave it there.
Well, one of the ways they've dealt with this in the European market now with the new centralised registry is the trusted account register, so that they can have a process by which you can get over those additional problematic hurdles by knowing that that person's already been checked out by the regulator and goes onto that list. So maybe there's a proposal for a modification.
But that's probably a ways out, because right now the market is still extremely fragmented, and it's really a project by project, which then means it's a contract by contract, and it means at this point it's a legal solution and not yet a technological solution, and maybe it will evolve over time, but the reality is that this provision will likely prevent the formation of a lively secondary market for offset. It's going to remain very much
So we're back to
OTC,
toddlers again.
Right, bilateral, very focused on specific project risks.
Good. Well, I think we are out of time now. Sorry. So I want to wrap this up. I want to thank all of you for sticking around despite the fire alarms and the excitement, even in this dull market. And thank our panelists. I think this was a really great conversation. Thank you, guys.
Thank you, Zoe.
And I believe we have lunch teed up for everybody now. So thanks a lot, and I hope you all enjoy the rest of the